You're lying in bed, staring at the ceiling, scrolling through your phone. Someone just posted a picture from a beach in Greece. Another friend is showing off their new car. Someone else is celebrating finally becoming debt-free. You lock your phone, open your banking app, and suddenly your chest tightens a little. The numbers staring back at you don't feel like freedom. They feel like a countdown. You start wondering, am I behind? Is everyone else doing better than me? Or are we all just faking it? Here's the uncomfortable truth. Most people have no idea how bad normal actually looks until they see the numbers. And once you do see them, you can't unsee them. Welcome back to Narrative Finance, where we break down the psychology of money, the hidden systems shaping your life, and the numbers that quietly control how people feel, act, and make decisions. Today's topic cuts deeper than usual, because when it comes to money, most people don't know if they're doing well, doing poorly, or just surviving. We judge ourselves based on what we see: vacations, cars, apartments, confidence. But none of that shows the truth. What actually reveals how people are doing isn't their lifestyle, it's the numbers behind it. And when you look at the real data, what people earn, what they save, how much they owe, what they fear, and how close most people are to financial collapse, you start realizing something unsettling. The average person isn't who you think they are. They're more stressed, more fragile, and more overwhelmed than they appear. But here's the part that matters for you. Understanding these numbers is not about comparison. It's about clarity. Because once you see what normal really looks like, you finally understand why so many people feel stuck and how a few intentional decisions can put you miles ahead of the curve. So let's break down the money truths most people never hear, and the ones that quietly shape their entire financial lives. Stat number 1 reveals something most people never notice. The average U.S. household income in 2024 was $121,000. Sounds great, until you understand how misleading that number is. It's a mean average, inflated by a small group of people earning far beyond everyone else. The real picture comes from the median income, $83,730. That's the number in the middle, the one that shows what a typical household actually brings home. And the gap between $121,000 and $83,000 exposes a hidden truth. The average American earns far less than people assume. This is why 2/3 of Americans live paycheck to paycheck. Not because they're irresponsible, but because the numbers that define normal have been distorted by outliers. So when someone looks at their paycheck and wonders, why doesn't this feel like enough? The answer is simple. They've been comparing themselves to a financial mirage, a version of America that doesn't really exist. Stat number 2 shows how dangerous timing the market really is. If you miss the 10 best days in the stock market over the past 30 years, your total returns would have been cut in half. Miss the best 30 days, and your returns drop by a staggering 83%. That's the part nobody expects, because the best days don't happen when things look safe. They often show up right after the worst days, when fear is highest and everyone wants to pull their money out. Just like in 2020. The crash came fast, but some of the biggest gains in history followed only weeks later. And that's what traps the average person. Fear pushes them out at the worst moment. Uncertainty keeps them out when the rebound begins. They're staying safe, but losing more than they realize. This stat matters because it exposes the emotional side of investing. You don't lose money by being wrong about the market. You lose by getting scared out of it. For most people, the real strategy isn't exciting. Stay invested, stay consistent. Let time do the heavy lifting. Stat number 3 reveals a cost most people never notice, and it quietly drains them year after year. According to the National Financial Educators Council, low financial literacy costs the average American over $1,000 every single year. It doesn't show up as one big bill. It shows up in tiny mistakes that pile up: a missed credit card payment, a bad interest rate, a savings account that earns almost nothing, avoiding investing because it feels intimidating. Each one seems small until you add them up. And here's the deeper truth. Nobody taught most people how money works. Not in school, not at home, not anywhere. So people end up paying a knowledge tax without even knowing it exists. This stat matters because it proves something powerful. You don't need to be a financial expert to get ahead. You just need to stop losing money in the dark. Learning one concept at a time, one habit at a time, can take those $1,000 you're losing and turn them into $1,000 you keep. Stat number 4 exposes how vulnerable the average person really is. 18% of US adults say the largest emergency expense they could handle right now, using only savings, is under $100. That means nearly 1 in 5 people would struggle with a small car repair or a vet bill. Only 63% could cover a $400 emergency without going into debt. And in the UK, things aren't much better. The average savings balance is skewed upward by wealthy savers. In reality, 2 out of 5 Brits have £1,000 or less set aside, barely a month of survival. This is where financial fragility becomes a cycle. When you can't cover small emergencies, you turn to credit cards. Then, next month's income goes toward paying last month's crisis. The debt grows, the stress grows, and the future shrinks. But here's the important part. Resilience doesn't start with big numbers. It starts with consistency, even if it's $20 a week. You're not just building savings, you're building the identity of someone who can handle life when it hits hard. Stat number 5 reveals a quiet crisis hiding inside the workplace. In the US, 33% of private sector employees don't have access to an employer-sponsored retirement plan. No 401k, no employer match, no automatic contributions growing silently in the background. And even among those who do have access, only about half actually contribute. At first glance, it looks like a discipline problem, but it isn't. It's a system problem and a psychology problem. When your day-to-day bills barely fit inside your paycheck, saving for a distant future feels impossible. And when nobody teaches you how compound growth works, you don't realize how much you're giving up by not starting. The UK solved this with auto-enrollment. Employees are automatically signed into the pension plan unless they opt out. Participation jumped to 75%. Not because people suddenly became disciplined, but because the system made saving the default. This stat matters because it exposes the truth. Most people aren't choosing not to save for retirement. The system makes it hard, confusing, and easy to ignore until it's too late. Stat number 6 is one of the most surprising. According to Vanguard, having just $2,000 in emergency savings increases someone's reported financial well-being by 21%. Not $20,000, not $200,000, just $2,000. And the effect keeps growing. People with enough to cover 3 to 6 months of expenses see an additional 13% boost in well-being. Here's the part most people miss. This isn't about becoming wealthy. It's about escaping survival mode. Without emergency savings, people spend twice as much time worrying about money, even if they're investing. Those without a buffer spend around 7 hours a week dealing with financial stress, compared to just under 4 hours for those with savings. They're also 4 times more likely to be distracted at work. That's what a cushion really is. Protection for your mind, not just your bank account. It gives you room to breathe, room to think, room to make decisions from clarity instead of fear. Even a small buffer changes everything. Stat number 7 is the one people never believe at first. According to PNC's 2025 Financial Wellness Report, 67% of Americans say they're living paycheck to paycheck. And here's the shocking part. This includes nearly half of those earning over $100,000 a year. It doesn't make sense on paper, but it makes perfect sense emotionally. As income rises, spending rises even faster. New clothes, better restaurants, a bigger place. Because now you can. Small upgrades that feel harmless until they quietly absorb the entire raise. This is lifestyle inflation, the invisible force that steals financial progress from people who should be thriving. And once your expenses stretch to match your paycheck, you lose the one thing money is supposed to give you: breathing room. This stat matters because it proves something uncomfortable. Earning more doesn't fix the problem if your habits scale with your income. The real solution isn't willpower, it's automation. Pay yourself first before lifestyle gets a vote. Stat number 8 shows one of the most dangerous financial traps in America. Nearly 1 in 5 new car buyers, 19.3%, are now paying over $1,000 a month for their car. And the average loan term? Almost 70 months. Nearly 6 years of payments for an asset that loses value the moment you drive it off the lot. The average amount financed is $42,388, with a down payment of $6,430. Used cars aren't much better. An average payment of $559, a 10.9% APR, and loans stretching almost 70 months as well. What this creates is a long, quiet drain on the average person's financial life. A car stops being transportation and becomes a monthly anchor, a bill that limits every choice, every opportunity, every raise. People don't realize it, but a $1,000 car payment doesn't just cost money. It costs momentum. It steals the chance to build savings, invest, or get ahead. This stat matters because it exposes a painful truth. Many people are driving something that looks impressive, while sacrificing the very financial freedom they're trying to reach. Stat number 9 reveals a burden that follows people for decades. In the U.S., the average student loan balance is $42,673, including federal and private loans. The typical monthly payment is around $503, and repayment often stretches 20 years or more. For graduate students, the average balance jumps above $60,000. But here's the part most people don't see. This debt doesn't just live on a spreadsheet. It shapes careers, delays families, and shrinks the options people feel they're allowed to choose. The UK offers a sharp contrast. Graduates there carry an even higher average balance at around £53,000, but their system works more like a tax. Payments only start once you earn above £27,295. They pause if your income drops, and after 30 years, the remaining debt is wiped away. In the US, none of that exists. You're expected to pay every dollar back, no matter how long it takes. This stat matters because it shows why so many Americans feel stuck. They're starting adulthood with a bill that behaves more like gravity than debt. Stat number 10 sounds inspiring at first. 7% of the U.S. population are millionaires, about 23.8 million people. That's more millionaires than the entire population of Florida, and the U.S. holds nearly 40% of all millionaires in the world, far ahead of any other country. But when you look deeper, the illusion becomes clear. The word millionaire doesn't mean what people think it means. Some reach that number through decades of slow investing, others through home appreciation. Some are paper millionaires, with assets that look large on a balance sheet but don't translate into real freedom. And most importantly, being a millionaire doesn't guarantee peace, stability, or good financial habits. Many still worry about money. Many feel behind. Many live lifestyles that keep them stressed despite the number. This stat matters because it breaks the fantasy that millionaire is a finish line. It isn't. It's just another number, one that hides more complexity than it reveals. Real security isn't about crossing a threshold. It's about building a foundation that doesn't collapse when life hits. When you look at these 10 statistics side by side, something becomes painfully clear. The average person isn't failing. They're overwhelmed. Their income is stretched, their savings are thin, their debts are heavy, and their confidence is fragile. What looks normal from the outside is often a quiet battle on the inside. And once you see the truth behind the numbers, you realize something powerful. The goal was never to be average. The average person is stressed. The average person is stuck. The average person is carrying financial weight they were never taught how to handle. But you don't need a miracle. You don't need a six-figure salary. You don't need perfect discipline. You need clarity, consistency, and the willingness to stop comparing your life to snapshots that hide the struggle behind the scenes. Because the moment you stop chasing what looks normal and start building something intentional, you're no longer playing the same game everyone else is trapped in. You're stepping out of the cycle and into a life that's actually yours. If today's breakdown helped you see money a little differently, make sure to like this video. It really helps the channel grow. And if you want more content that blends psychology, numbers, and real financial clarity, subscribe to Narrative Finance so you don't miss the next episode. Now tell me, which of these 10 stats surprised you the most, and which one hit a little too close to home? Share your thoughts below. Your comment might be the perspective someone else needs today.